With all this market turmoil, how should investors be thinking about energy? Let's get some thoughts from David Szybunka, Senior Portfolio Manager and Co-Managing Director of the Energy Team at Canoe Financial. David, thanks very much indeed for joining us.
Hey, thanks, Andrew.
Start off with oil, if you would. Why is it so weak? The US dollar is down. You think that would be inflating the price of crude?
Yeah, you know what? I think it's really important for people to understand commodities in bigger cycles. We keep telling our investors commodity cycles last 10 to 15 years. We think that we're in year 4 or 5 of a commodity cycle. And so when we just kind of look at these commodity cycles, they never go in a straight line. Everyone wants them to, but various commodities lead along the way. And so when we just look at what's happening in the bigger picture market, as you'll recall, people didn't really like gold last year. Now we're really watching gold break out to the upside. In the last 70 years, there's been 3 major uplifting gold cycles. This is now the 4th. And so this has never happened without it being a commodity cycle. It's not just a gold cycle, it's a commodity cycle, and various commodities lead along the way. So this is really notable for investors from our stance when we're watching these various commodities happen. You just brought up the US dollar, which tends to become a tailwind for commodities along the way. So we shouldn't get too focused on kind of the day-to-day ticks within a certain commodity, in our view, because this bigger structural cycle is playing out.
But how is it? I mean, we've got a threat to world growth with these tariffs.
Yeah, I mean, on the demand side, it's important for people to understand a few things on oil. And so when you look at U.S. household income, today, energy costs for them are roughly 2%. Where this tends to become a problem is 6, 7, 8%. And so we're not seeing the consumer get pinched yet. Everyone's slashing their GDP estimates. And so people are bringing down their oil demand assumptions. We wouldn't be surprised if demand's a little better than people think because of that. And I think as we relay this to the energy sector a little more, you need to decide as an investor, do you think that this is the start of a multi-year downturn for energy? Or do you think this is a downturn measured in months and quarters? And I'd relay this a little bit to 9/11. 9/11, we were all told that we were never going to fly on planes again. And 6 months later, we were all back on planes. So when you look at what was happening late cycle in the energy sector, 2012 to 14, capital was flowing in. Energy was outperforming. Everyone loved the sector. Valuations were high. Investors were embracing the sector. Companies were spending. What ends a commodity cycle is a capital spending cycle. This was very prevalent during that 07 to 2014 period. We kind of look at how it looks like today. The sector hasn't been outperforming. You've watched energy be at one of the lowest rates it's ever been. Valuations are low. Companies have discipline. They're handing back all the money. Balance sheets are clean. We're in the months and quarters camp. And when you're in the months and quarters camp on these demand scares, if you will, it's hard for me, a guy like me, to say today's the day. But I think the position should be, you should be building positions in periods like this, not looking down like everyone else.
Now, you have an amazing figure for us. Energy as an outlay represents only about 2% of household income. That's pretty low.
It's very low. And that's where what tends to hurt the consumer. Like I've been in periods before where you structurally underinvest in commodities. The commodity prices are spiking. You're now 6, 7, 8% of the energy income. I'm going there going, why aren't my oil and energy stocks going up? It's because the market's already sniffing out this isn't good, right? Today, we've kind of watched oil. It hasn't really rebounded too much, but look at copper. Copper's right back to the highs. I thought we were going into a big recession. So I'm not saying oil demand isn't going down. I'm saying I think a lot of people are overestimating the hit to oil demand, and I just don't think prices are going to be down here that long. Like I said, when I talk about these bigger cycles, like gold to oil ratio is at the highest level it's ever been, and no one likes oil now. When you look at oil positioning, it's at the lowest net positioning since COVID. And so this is not me pounding the table, and I'm just saying I think we should be kind of looking a little bit more up than down as we kind of pass forward a few quarters here.
One name that you like, Tourmaline, a classic natural gas play.
Yeah, when you go through periods like this, it's never easy. And so when you just kind of play this out, it's important to not just be like, today's the day, let's have max risk. If this all goes up and to the right tomorrow, then you want max risk. But you look at names like Tourmaline, These are bellwether names that should be in people's portfolios. It's our biggest holding within our funds. You're getting 5.5% dividend yields. That's what they paid out last year at the lowest gas price in 20 years. And so that's the dividend yield at that low commodity price assumption. And this is a really good company that has really good assets that your downside upside on some of these names from these levels is pretty intriguing to us.
And then Topaz Energy, a spin-off from Tourmaline.
Yeah, again, when I look at the year-to-date performance of some of our royalties in our backyard, the Prairie Skies, the Topazes, they're down kind of 15 to 20%. Everyone's kind of throwing these things out with the bathwater, and these are really good businesses, right? When you look at the Topazes of the world, like you said, they have a royalty on a lot of Tourmaline's acreage, but they also have a lot of exposure to the Clearwater. And this is where the men separate from the boys at 60 versus 80. Some of these plays screen really, really well, and Topaz has a lot of exposure to that. And the dividend yield is 5.5–6%.
And then finally, Prairie Sky. Interesting, they have been apparently quietly building up oil sands acreage.
Yeah, I mean, their acreage position has skyrocketed since their IPO. And I'll remind everyone that we all lined up to play the IPO at late cycle 2013-14. The valuation was almost 30 times cash flow. When we look at other royalty businesses within the U.S., Texas Pacific Land, they trade at 30 times cash flow. Landbridge, a bunch of these various things, even the Franco-Nevada, Wheaton Precious Metals, royalties are really good businesses. And today you're buying Prairie Sky at half the valuation of 15 times. We think that these are really good risk-adjusted returns for our investors in our portfolio.
Thank you very much, David. David Szybunka joining us there. Really appreciate it. David is Senior Portfolio Manager and Co-Managing Director of the Energy Team at Canoe Financial.